I think the risk this year is something like a DeepSeek moment happening again. And I think it wouldn't be a fundamental story. It would just be a panic. AI is going to be the theme to go on. It's not going to be slowing down anytime soon. We're going to see multiple Fed rate cuts this year. I think Google and Nvidia will continue to do very well. If it's a bubble, this would be the first bubble in history where supply cannot keep up with demand.
Welcome to The Big Skinny with Lou Basenese. It's a time of year where everyone is making predictions, some of them bold, some of them a little bit mundane, but there's absolutely no shortage of them. And I'm excited this week to have with us Phil Rosen, the co-founder of Opening Bell Daily, which is read by over 200,000 independent investors, as well as the host of The Full Signal. Phil, welcome to The Big Skinny.
Thank you, Lou, for having me. Excited to be here.
Yeah, listen, I'm excited for this conversation because you consume and talk with more experts on Wall Street probably than anyone else, their opinions, their insights. So I'm curious to see how you distill that down and what it makes you think your crystal ball says for 2026. So
yeah, I think I personally have a bias for optimism. So most of the people I talk to, and all the folks I talk to, they tend to be more bulls than bears, I would say. And I think part of that, one, is my own bias, but a second part of that, this market has been so resilient and so impressive that it's getting very hard to find bears to talk to.
Yeah, it's true.
So, I think one, there's just such a strong bull tape right now. And two, I think monetary policy for years now has been very accommodative and people have been betting on it to get more and more accommodative. So it's very hard to take the other side of asset prices going up.
Yeah. No, it is. I don't know there's many people out there except those perma bears that are always arguing the other side. So I thought we'd start with a couple like rapid fire questions off the cuff just to get us warmed up here.
Let's do it.
Maybe create some entry points for further discussion. So no bold predictions for 2026, but what do you think might be a surprise this year for the markets?
I again, the folks I'm talking to, my own opinions included, AI is going to be the theme to go on. It's not going to be slowing down anytime soon. That's not an out of consensus view.
Right.
But I do think that a lot of these Wall Street analysts, they're saying, oh, we're going to see a 10% year in the S&P 500. I think that's underselling it.
Yeah, too conservative.
I think we're going to be much higher than that. And the thing about these Wall Street outlooks, they always say 10%. When you take the average, they're all going to sort of pile around the 10% historical average. And almost every year, it's way more or way less.
Yeah.
I'm going to take the upside on the 10% this year. And
all right, so you're taking the over on Wall Street analysts. What do you think the risks are to that? What's the biggest risk that you see on the horizon that people might not be thinking about?
I think the risk this year is something like a DeepSeek moment happening again. And I think it wouldn't be a fundamental story. It would just be a panic. I don't think that the fundamentals of AI are that much to concern about right now. But I do think if we get something that's sort of a black swan AI related thing that comes into the picture, a lot of people will get very spooked very quickly. And you already have these tremors of folks saying, look, I want to start rotating into other corners of the market that's not tech exposed, that's not OpenAI or Nvidia exposed. And they're looking for, sort of boring plays. I think they'll lose a lot of money, generally speaking.
Yeah.
But if people get a reason to get out of AI, they will take it.
Yeah, so justification for being safe instead.
Yes.
So I want to go back and unpack that a little bit later on, but let's move to another one quickly. Fed independence. Who do you think's in control of the Fed, Powell or President Trump?
That's a hot question. I think generally the successor to Jerome Powell, they will have a much more dovish bias than Powell or anyone's had in a few years. And it's very hard to parse whether that's going to be their own view or whether that's just President Trump's view.
Yeah.
Because President Trump, he's not been shy about saying, look, let's flatten rates to zero. Let's get someone else in there who isn't so hesitant to lower rates. And whoever succeeds Powell, they're probably going to do just that.
Yeah.
And I am in the camp where we're going to see multiple Fed rate cuts this year. I think a lot of people are only expecting one or
only
two.
One, right? So that could be your bold call of 2026.
Maybe.
Multiple rate cuts.
I don't think it's going to be out of consensus within a few months because once we get the successor in there, Trump is going to badger him publicly and privately to say, let's get rates to zero. Trump looks at the stock market as a scoreboard for his presidency.
Absolutely.
And when asset prices are going up, Trump views his own job is effective. So he wants someone in there that is going to help inflate asset prices, and that happens when rates are lower.
Yeah, no, makes sense. This is going to be a tricky one, right? I don't know if I have an answer, so you can throw it back at me after the fact. If you could look at one chart for the entire year, what would be the one you had to focus on? If you were basically had to make your decision based off of one chart moving up or down, what's that key indicator for you on whether to be bullish on the markets or bearish?
That's a great question. The one that I saw in December that I thought really told a great story of the year was the Mag 7 individual charts in a bar chart compared to the S&P 500, because you only saw Google and Nvidia outperforming the S&P last year. I don't know what other names can play catch up this year. I think Google and Nvidia will continue to do very well. But as far as, some of the other names, I think Tesla can do very well this year. I think there's a big catch up. The others, I'm not so sure. But if we come back in 12 months and look at that chart again, that will probably be a pretty good snapshot of how the year went. Yeah. One, you have how the Mag 7 did, but two, you also have how did the broad market do? And I expect probably, again, double-digit gains of the broad market. Nvidia, Google, they're not going anywhere. And something I hate is when people say, who's going to win the AI race in these stocks, right?
Right.
If the AI technology and trend is what we think it is as bullish investors, it will not matter.
Yeah, everyone gets a participation prize, right?
Everyone's going
to win
well.
in a way. Yeah.
Yes.
So it's funny. I'll answer the same question. I think it's interesting. I said the Mag 7 is like a boy band that broke up about 18 months ago, so that you see this individual performance. Didn't have as much in Nvidia. Definitely saw Alphabet, and I agree that it's not going anywhere. For me, if I had to look at a chart, I'd look at the AAII individual investor sentiment, bullish sentiment. Every time it drops below 20 or 19, 6 months later, the stock market's up. It's like the most reliable contrarian indicator for me. So when everyone thinks one way, I go the other way. So yeah, anyway, so dovetailing that, I think Mag 7 is interesting. One myth in the market that you think that particularly retail investors maybe need not to fall prey to this, like I think of the headlines of the AI as a bubble. Is that the biggest myth in the market to you? What do you think is the risk of believing the consensus? Is there one particular topic or trend that you think there's danger in it?
I mean, the bubble narrative, that's always one that is very enticing, I think, because when you call a bubble, you feel smart and you sound smart. Right. And you side with the media. And people look at journalists and reporters and they say, well, if they're writing this on the front page of Barron's or the Journal, they must be right. But usually the front page of Barron's or even the front page of The Economist, they're contrarian indicators. Yeah. At least that's how I see them. Because if they're putting, something about, the market's about to crash, it's almost never going to crash. Yeah. So that's just a trap, generally speaking, in any year for retail investors. I don't know if I have one to call out in particular for this year, other than, I would say it's not wrong to take the opposite of whatever the media is recommending. And I say that as someone in media.
No, I was going to say that's where you came out of. I mean, award-winning journalist, writing, doing that frequently. I think it's funny because you bring up a good point, because I think it was maybe a week or 3 weeks ago when OpenAI had to come out and deny a Reuters report that they were delaying one of their data centers. And they had to say this is categorically false. I feel like the media is just looking to be the one that calls the top and say, see, we told you so in AI. So let's talk about what you're hearing, because I think you have a unique vantage point that people might not automatically know, is that you're consuming research and speaking with the experts across Wall Street, people that have very proven track records. So I feel like you're getting a unique bird's eye view of really what's consensus, what overlaps, where's the mosaic coming together. What do you see, or what are you hearing, and what do you make of it about AI and the durability of that growth trend?
I will say the investors who do not believe in AI, most of them manage portfolios that focus on fixed income. So they're not really in the arena, let's say. Yeah. But if we put that aside for a minute, the folks that I'm speaking to who I trust their take the most, they're the ones that are going to the factory floors in Asia and seeing the demand story over there. And they're the ones that talk to the managers of these companies. And, they almost take the Warren Buffett style approach where they're in the trenches and seeing the technology, seeing the hardware, things like that. And the resounding story is that these companies cannot keep up with the demand, and the demand is stretching out for sometimes a decade. Right. And, who knows if that plays out in that way. I think time will tell. But generally, the optimists are, they seem to have been right so far last couple of years. And if anything, their conviction has only deepened in, let's say, the last 6 to 8 months or so. And again, it's hard to parse whether, okay, if everyone's saying one thing, maybe it's time to start to be cautious.
Yeah.
But you could also just say, all right, if it's a bubble, this would be the first bubble in history where supply cannot keep up with demand.
Yeah, no, I think that's a good distinction because you saw Nvidia coming out saying they can't keep up with demand, Micron coming out saying they can't keep up demand. I think the bear case is really focused on their debt spending, right? So like the amount of CapEx they're doing relative to revenue and then also now taking on debt. Oracle, for whatever reason, become the poster child of that. What do you make of that? Is that just smart financial management where we're saying, hey, we have a huge growth trend ahead of us, let's lever into it and earn better returns? Or is it just risky behavior?
It could be a little of both. I think the circular financing is probably the biggest red flag of the whole boom right now. And you could say that it's a consequence of innovation in general. You could say every innovative period in technological history, sometimes the financing is shady. That just happened with the internet. Could be happening right now. We don't really know. But I think that could just be an outgrowth of the competition and the race. People are going to do whatever they can to get ahead, build these products, build the infrastructure. And sometimes that might mean using the same dollar 5 times.
Yeah.
Who knows?
Yeah. I mean, look, the Fed does it, right? The money supply keeps accelerating. It's Fed circulating the same dollars. All right. So you're not worried about the accelerating pace of what is AI demand. What do you see as the next kind of derivative plays on AI, right? Like the chip makers were the obvious first primary beneficiary. Do you see first and second derivatives of that? I mean, what layer of the market do you see that benefiting AI next?
Yeah, I think the first wave was really trying to capitalize on these large language models and figure out ways to play that with the chips, like let's say Nvidia. But then the next stage, as far as I can tell, and again, I wouldn't call myself a technologist by any means. I think I talk to a lot of smart people, so I kind of gleaned some insights there. You have a company focused on hardware. That's probably going to be the next chapter, let's say, of the AI trend, which is why I think Tesla is positioned very well. They're building Optimus. They have their cars. I've seen Elon Musk talk about how all their cars together can provide something like a hodgepodge data center of sorts, which is a crazy idea that only he could do. So I think the hardware play is probably the next leg. But again, I think we're going to see a bunch of companies in the next few years that don't exist right now that are going to build amazing products and also probably go public with ridiculous IPOs.
Yeah, no, I think that's an interesting point because I think we're teed up now for some really big IPOs this year. What do you make? I mean, SpaceX, Anthropic, Strava, which is a tech one on the fitness side, but a lot of a backlog of big IPOs, which traditionally haven't been great performers for people that buy in the aftermarket right after the IPO. What's your viewpoint on IPO performance and what's coming?
Yeah, these IPOs generally are very flash in the pan, I would say. When you talk about SpaceX, though, and Anthropic, I've talked to multiple people for both of these companies. They're already talking about putting their net worth into both of those IPOs. And people are extremely, extremely excited. And that, when you start hearing that, then it starts to be like, oh, the shoe shine told me to buy this stock.
Right. Yeah.
And if
the taxi driver told me to buy it. Yeah.
And so then it's like, all right, what's going on here? Why is the hype so concentrated and so intense right now? But then at the same time, you could say, why would you not bet on the most revolutionary, innovative companies of our time with everything you got? So
valuation always comes into that, which I think brings up another topic, right? We look at the forward PE multiple of the market. It's getting stretched versus historical norms. We talked about this a little before we came on, and just about a rotation happening in the market, right? Some out of staples, which was always defensive, but you talked about too, the divergence in Mag 7. So there's a little bit of rotation out of this primary tech. What are you seeing in terms of sector performance, rotation? Is it healthy in your opinion, the people you're talking to? I mean, how do they put this in perspective of the bull market?
Yeah, I would say generally the bull market does seem to be, let's say, getting healthier, quote unquote, because you have generally a broadening out. You see small caps picking up. You see other parts that are not touching the AI trade picking up. And I don't focus too much on sector by sector performance, but I do know that generally it does look like there's more risers than fallers. And I think that's been happening for several months. These defensive sectors are sort of falling and people are less interested in these defensive sectors also. So that's another interesting angle. But again, whatever the broadening out story might be, it could be, we could see a huge trend of broadening that will not overtake, at least in the conversation and the enthusiasm for the tech trade.
Yeah, so tech dominates still. I mean, in your opinion, it's not an issue that it's 38% of the S&P 500 and that doesn't concern you at all. Does it concern some of the people you talk to?
I think it's very hard to avoid tech exposure. And I think that is a troubling thing for a lot of people because they say, look, if I buy the S&P, a third of that is going to be tech or AI. And a lot of people don't like that. The way I see it, the economy has never been more tech heavy, like the real world economy. Totally agree. Just because the market is tech heavy, I think that actually reflects increasingly what the world is like. Yeah. So, the economy is not the market, and I get that. But I also think that why wouldn't it make sense for the market to become more and more tech heavy as our lives become more and more tech heavy?
Yeah, no, you articulated better. I always said I think of the world as 100% tech because even if you're not a tech related company or tech direct company, you're adjacent to tech. You use tech even the most archaic companies and businesses are using technology in some form or fashion. So it's all connected. Interesting. Let's pivot away from tech, like complete opposite side, the most non-techy thing, gold and Bitcoin, right? So one non-tech, one tech. Gold outperformed Bitcoin last year. What do you make of that? Because you wrote an interesting piece of saying 1 year it looks like strong outperformance. Zoom out to 5 years though, and it actually flips. Bitcoin's doing way better. So how do you look at both of those assets?
The gold bugs had so much to celebrate last year. They had their best year in history, I'm pretty
Peter
sure.
Schiff has never been more celebratory for
exactly.
sure. Exactly.
And by all means, I think that's fantastic. I'm not anti-gold.
Yeah.
I think gold is a great asset. I think it's a fantastic store of value. But when you say, okay, in this one calendar year, gold has outperformed Bitcoin and Bitcoin is actually negative for, I think, the third time in the last decade.
Yeah.
Obviously, you have this huge gap and there's going to be a huge sentiment disparity. And you're getting a lot of haters coming onto Bitcoin saying, I told you so. Yep. This is not a great investment. It doesn't keep your purchasing power, whatever. I think that was probably one of the biggest surprises of the year for me, seeing Bitcoin underperform so dramatically, because it wasn't as surprising gold did that well. Maybe.
Do you think it was a momentum trade, a catch-up trade on just all the money printing that had happened for decades before that we really didn't have that adjustment re-rate in gold? Or do you think, what do you think were the underlying dynamics of that?
I think partially gold was a big beneficiary of that, but then you also had the headlines popularized the term the debasement trade.
Yeah.
And I think a lot of traders and academics have known of that trend for a long time. But once it became mainstream retail sort of, conversation, everyone paused into gold. I had a lot of friends for the first time in their life buying the gold ETF, even though these are, 20, 30-year-olds that really have, never talked about buying this rock before.
Yeah, not the right demographic for a gold bug.
Exactly. Yeah. And suddenly you got everybody buying gold. I think that probably pulled some flows away from Bitcoin. But the interesting thing about Bitcoin, 2025 was supposed to be the defining banner year for Bitcoin. Yeah. We had a pro-Bitcoin White House. We had legislation that was pro-crypto. We had ETFs coming online that were really building momentum. BlackRock is in the game. You had institutional buy-in. And yet Bitcoin was negative. That, I think, shocked a lot of people.
Do you think there was too much DAT strategy companies that got funded? Maybe because for me, I looked at the DAT strategy as a low friction way for institutions to get exposure to Bitcoin. And did we just open up the world too fast and we just need some natural consolidation? How do you view that just overlaid with a pure Bitcoin exposure?
I think that's a great variable to take into account too. The DATs, I think, are still an unproven, unpredictable piece of the market. And I don't really do too much work on them. So I think TBD. Generally, though, the Bitcoin momentum that I think we expected last year, all those tailwinds are still in place. They nothing happened.
It didn't go away. You just returned the calendar. That's all.
Exactly. And so I'm expecting Bitcoin to do fairly well this year, not as a catch-up, but just because all the reasons to be bullish are still there. And then you also have the really zoomed out 10-year bull picture where it's just if you want to protect your purchasing power, Bitcoin has been a great, albeit volatile option for that.
Yeah. So quick question on that, just a finer point. Do you think gold and Bitcoin are mutually exclusive? Should you own one and not the other? Does one act as a hedge against your other hedge? I mean, how do you view that? I mean, there's the ETF out there that's 200% gold and Bitcoin, right? So you get leverage to both of those. I mean, does that make sense to you or counterproductive?
I think for the average investor, it wouldn't hurt to own both.
Yeah.
I think most, let's say older investors will be just way more comfortable with gold because the volatility is so much lower.
Yeah.
But to me, if you want outsized returns, you need outsized volatility. So as a younger person, I would lean more Bitcoin. I actually don't own gold. I do own Bitcoin though. And part of that, I missed the last year's gains, of course, but the drawdowns, the volatility, that doesn't bother me because I have a 30, 40, 50 year time horizon.
Time horizon. Yeah, that makes sense. All right, so let's take a step back a little bit into your day-to-day activities, right? So you have the difficult task of trying to figure out what you're going to write about every morning. What's your process like? What do you discern? How do you discern the signal from the noise as you're deciding what to put out to 200,000 plus people every morning?
Yeah, that's a great question. I talk to a lot of people. So I talk to a lot of investors, across the retail and institutional side. I talk to a lot of fund managers. I talk to economists and strategists. So I try to get as many takes on what's going on every day, every week. And my job, I see it as synthesizing all of that to a single defining story of the market that day.
Yeah.
So I publish 5 days a week. Every day the market's open. And the North Star, you could say for me, what's the smartest thing I could say about the biggest story in the market that day?
I like it.
And when I use that as the filter, it actually narrows things down quite well for me. So it's not as hard of a choosing process as it might seem from the outside. Because yes, every single day, especially these last couple of years, markets have been insane. But if I try to really, really prioritize information, then the noise and signal and noise becomes pretty clear.
Yeah. So you heard it here first. That's an easy way for you to do the same thing because it's still down the noise to the signal by being a subscriber at Opening Bell Daily. But then you also tell me about Best Ideas Club. I'm a member, but now you're taking it from not just the news flow and the information flow, but actually putting it into action with investment. So what's the big idea behind the Best Ideas Club? And then just talk about that a little bit and how people can join.
Best Ideas Club comes out every Sunday. I write a report based on an interview with a world-class investor, one a week. And essentially I say, give me your highest conviction stock pick for the next 12 months. And then someone tells it to me, they break down their thesis, the risks, their time horizon. And then I write the report and we send it out to our members on Sundays. And so we launched this last February. So we're about, let's say 11 months into this. And I checked this morning, the Best Ideas Club Equal Weight Portfolio, which is a paper portfolio, is up, I think, 23%. And then in the same time period, the S&P is up 14.5%.
Yeah, so outperforming already.
We're outperformed the index and we're almost to the 1 year mark. So I'm excited to see how that develops over time, because in theory, if you get the smartest people telling you only their highest conviction stocks, it should crush the market.
Yeah.
It doesn't always happen. And professionals try to make a living doing this. It's very difficult. But so far, we've been humming along pretty well. And I think our subscribers, they tell me at least that they like what they're seeing.
No, dude, I'm a subscriber, so I enjoy the content that's coming across. Good idea generation. You had one there from Nancy Tangler not too long ago, and some other people I truly respect. Where can they go to sign up for Best Ideas Club?
OpeningBellDailyNews.com is where you sign up for the newsletter.
Yep.
And when you sign up for the newsletter, you can also choose to sign up for Best Ideas Club, which is our paid service.
Awesome. Well, I encourage everyone to do that. I'm a subscriber. Covered a lot of ground today. Your predictions for gold and Bitcoin, AI, key things to pay attention to, that Mag 7 chart versus the S&P 500. I've got the easiest question I'm going to ask you all day long. Favorite place to get a bite to eat or a beverage on a Friday afternoon in New York City?
Oh man, see, this is actually the hardest question because the thing is, and I'm embarrassed to say this, all I do is work and look at the market. Yeah. I don't really go out much. I don't go to restaurants that much. So I'm gonna have to take a flyer on this question. Ask me anything about the market, but social life in New York, I'm not too good at that.
All right, well, we're going to come back and join Phil sometime later in this year, and he'll have an answer to that question, hopefully, man. I appreciate you taking the time and sharing your perspectives with us, man. Really appreciate it.
Thank you for having me.
All right.